Evening, guys.
Hello.
How's it going?
Very good.
Good?
Yeah, how are you doing?
Very good. Very good. Ready for a weekend. Ready for a weekend. I'll get into it because I don't have tons of time. Now, I'd like plans to go through the content and a bit of a Q&A at the end, but I'm totally fine. If you got questions, just put your hand up and let's just get it out. Because I'm going to cover two topics, valuations and forecasting today. Fun topics. Fun topics. Which, to be honest, is not as much of a science or process like IP, right? So a lot of variation in it. So, but just for the room, how many of you product owner or startup? How many of you have e-business that you've set up or products that you're developing? Now, how many of you have products? Okay, a couple. How many of you are pre-product? Anyone with revenue? Okay, kind of. All right, good. So I'll give you a quick stuff I'm going to cover off. Intros, me, I'm from a business called Solid One Capital. We invest in businesses which we'd call as pre-seed, which is pretty much going to catch, I suspect, most of you. Valuations, the dark art, and forecasting, there's a better way to do it than what you've probably heard or seen before. So just a quick note on Solid Bond. So Solid Bond was set up about 6 years ago, the place I work for, by a guy called Steve Corns, who was one of the co-founders of AO.com. So grew it from pretty much nothing to its 1.2 billion float. And then works with his business partner, a guy called Shaz Solomon, which before AO, they scaled Phones for You. Anyone remember Phones for You? Okay, so they scaled Phones for You from 70 loss-making stores to about 400 stores, about £150 million of profit each year. So quite a significant business. Shaz went on to run 3 different private equity-backed businesses as well. So me, that charming chap on the screen, that's me. I went to the University of Salford, so not too far, forgive me. And I've had a handful of finance roles, but they've always been about looking how businesses are performing, digging into the numbers, digging into the KPIs, what's really driving performance, and working with operations. Qualified accountant as about 3 years ago now. But my role with Solid Bonds, I spend most of my time now with new businesses pitching for investment, taking them through our process. I'm part of the investment committee, so there's 4 of us that sit down and we agree what we put money into. And then I help structure the actual deals and the whole commercial arrangement around that. So I do that. And then we also have a little small finance team. Solid Bond's all about deploying capital, like up to 700K, 750. The smallest one we've done is 40. We're about to do another 30 into that same business, hopefully by the end of tomorrow. So we go right from early stage, kind of idea / very early product, into what you'd call really a seed round, or anything before a VC would come in. That's where we sit. Right? And we'll talk about where VCs come in a minute. But we have a bit of a team. So as long as investors that have been there and done it, we have a bit of team where we've all come from industry. We've all either been, in industry or operators, and I've been part of businesses' growth journeys. And we have a bit of a team. I have finance. We've got 2 other finance people in the team. We've got marketing. We've got a CTO. We have a commercial and technical guy that works with me a lot. Just to plug into your businesses or into early stage companies, just because we appreciate there are gaps in the journey that you're going through. Not forever, because once you raise more money, we'll disappear. Once you don't need us, you can backfill. But that's the Solid Bond model. So I want to talk about valuations. Honestly, please, any questions you've got, just jump in, okay? Just jump in. So a quick bit of terminology. Who knows pre and post money valuations? Hands up if it's a familiar term. All right, good. I'd planned on it not being too familiar. So when it comes to valuing your business, yeah, you're going to go out and raise money at some point. Who plans on raising money probably the next 12, 18 months? Right, a few of us. When you go to value your business, and we'll come on to how to do that or what that looks like, you have what they call a pre-money valuation, which is saying, today, my business is worth 800K, yeah? So my pre-money valuation is worth 800K. We'll talk about how to figure that one out in a bit. Now, if an investor might say, look, I'm going to give you 200K, because that's what you need to take it to the next stage. So the 200K gets added to your 800 grand. So if I had a business that was worth 800 now, you give me 200, it should just be worth 200K more. So I now have what they call £1 million post-money valuation. So pre-money is before you raise money. This is the baseline. This is what we think the business is valued now. And then post-money is after I've got the money in from an investor. That's my post-money valuation. And just to show you how it works, really simply, 200K divided by the million post-money valuation, you've given away 20% of the business, right? Does that make sense? So that's how the valuation mechanism works. You have a pre-money valuation, somebody gives you a bit of money, the amount they've given you divided by the new valuation is the amount you've given away in equity. So a couple of points to start with valuations. You'll hear about these massive hop-ins just being valued at 8 billion or whatever it is. Startup valuations does not necessarily equal business valuations, right? So the amount that somebody would pay for your product is not necessarily what you're going to be valuing it on. So you might have an idea, have a bit of a team, kind of, fumble together and you're a bit of a product and you're raising on a £1 million pre-money valuation. It doesn't mean you're going to go and find a buyer who's going to give you £1 million for it, because it's probably just cheaper to go and do it. Much cheaper to go and do it. But it's a mechanism to work out how much equity you want to give an investor. And over time, they do start to become the same thing. But at this early stage, they're not always the exact same thing. And unfortunately, businesses are actually worth what the market will pay for them, right? So no matter what people think about when you go into the process, what the business is worth, the market usually tells what the business is actually worth. So I've pulled together a little model. I'm really proud of this. Really proud of this. This is valuations over time. Probably not to scale because I've done it, but this is normally how they work. You've got these stages that we'll call pre-seed angel stage, which is probably a lot of what you would want to go and raise next. You'd have the stage after that. So if you were to put it in like the US vernacular, right? You'd have pre-seed, angel, you then have venture, which is like Series A, Series B. If you've heard those terms, they're going to be like your £3 to £10 million checks. You then have growth, which is typically where you see private equity coming in from like 10 to 50 million. And then you have relatively established businesses, often on a stock exchange. They floated or they're on the market. And the way that the market or investors will value a business differs depending on where you're at which point you are in the journey. At the beginning, well, actually no, let's start at the end. At the end, you've got loads of metrics, loads of numbers, revenue, it's very established. You've got other competitors who have been bought at a certain value that have got similar measures and numbers. It's quite easy to say, well, their annual revenue was 10 million and they sold for 100 million. So therefore this business has got 5 million, must sell for 50 million. It's quite easy to make that comparison because there's information and data. And that gets harder and harder the earlier you get. So down this pre-seed section, and I'll focus on there tonight because there's no point talking about that right now. An investor, there's no science, I'm really sorry to tell you. There's no formula or right answer to what a pre-seed investor would value your business at. We'll talk about stuff we can do, but really it comes down to, in bold, the quality of the founders. That is the number one thing that we at Solid Bond look for, is the quality of the founders and their ability to pull this business through and make something of it is absolutely paramount. How sound is the idea? What's the marketing risk? Do you know where the customers are? Do you know how to get them? What's the execution risk? Do we have confidence that the founding team or the team in place is actually going to be able to build what you're planning? Do we believe it's fit for purpose? And then comps, comparables. This is probably the single most useful thing for you guys if you're going to try and set a valuation for a business, is trying to work out what other businesses like mine raised at a similar stage and on what valuation did they do that. Probably the single most useful thing for you to help have a reasonable valuation. At this venture stage, you'll then start seeing it evolve a bit more. These VCs, they want traction. They want to see, do you have revenue? Do you have customers? If you don't have those, do you have a massive idea in a really big market that they'll keep funding? That's why you see all of these like super fast grocery deliveries raising stupid money, hop in, honestly, you could go on. Like a lot of them don't have a lot of traction at all. Big valuations because there's a big opportunity, and a lot of FOMO right now, which is going to crash, is crashing right now. So you got that. And then still a bit about the quality that the founders, sound ideas, and comparables as well. But they very much look now at exit potential. So imagine a VC. I'm taking £10 million of other people's money. My commitment to them is I've got to give them 30 million back. Okay. So in order to, all right, I need to get 3 times my money, which probably means once some businesses fail, I need to probably get 6 or 7 times return on each deal that we do. That's the goal. So you can work it back. You can say, if I give you £1 million now and you're going to give me 20%, by the time you raise money again and again, and you get to 100 million, I might have 10% left. Okay, well, 10% of 100 million is a 10 million exit, and I've put £1 million in. You know, that's going to be a 10x return. That fits the bill. So a lot of VCs will work it back and say, look, this is what we think the business can get to realistically, and we'll, whatever financial model you give us, we'll probably like reduce it by 40%. And then that's what we'll try and work back from. If you can do that, this is what the valuation needs to be today for us to get a target return. But again, a bit beyond, this is based on some information and a model starting to form. Growth stage, exit potential. So again, doing that target return, comparables, and then really the model has been quite proven. The way you get customers, how profitable each customer is, all of that starts to be a lot more proven. And then the market dictates, usually for established businesses. Guy here, Dave Burkus, I think he was a lecturer at Harvard, spoke about, he's done a lot of thinking about how to value pre-revenue startups. And he just said, pre-revenue, I do not trust projections, even discounted projections. So these nice fancy financial models which show the standard curve just like this, disregard them. And we'll talk a bit more about that in a second, but that is, there has to be a different way when there's no evidence that what you're doing is right or the market wants it. When you're still at this really early stage, how do you figure out what the business is worth and how much equity are you willing to give to someone? Okay, not projections. So be aware, the wrong valuation, going in with the wrong valuation can set investors off. I'll give you an example. I had a business this week, I won't tell you who, but I had a business this week that came to us saying, look, our business is worth £3 million. We're looking for 200K. Remember, so if 300K, if 3 million's the pre-money valuation, 3.2 would be the post. Does somebody want to do 200K over 3.2 million? It's probably about 4% or something like that. But that's going to be wrong. But yeah, it's not going to be a lot. It's going to not be a lot. So for us, we're looking at it thinking, all right, 4% for a business that has no revenue, has no product, has none of this, and 4%, by the time you raise money again and again and again, we're going to be at like 0.5% at some point, and it just doesn't actually it doesn't really stack up for us as well. So the wrong valuation can put off a lot of investors. And you probably watch Dragon's Den or something, you're thinking, don't just turn him down, negotiate, just offer him something. And unfortunately, often it just doesn't happen. That if you're coming in at 3 million and I think it's worth 600 grand, that's quite a big difference for me to say, nah, I don't believe it. So it can put people off. I've covered this point. Now this is probably the single best bit of advice that I could give you in terms of, I've got a business now, I've got a product, I don't have customers, or I might have very early revenue. I'm trying to figure out what is my business worth. The single best argument or way to value that business is to work out what have other businesses raised money on that are similar to me. It doesn't have to be exactly the same. I think I saw one of the businesses here, I don't know who it is, like ethical houseplants, peat-free. Okay, there we go. So peat-free houseplants. I'm not sure if there's going to be a tremendous amount of information you can get about other peat-free houseplant suppliers, but there will be some type of growers that you'll be able to do that. And resources you can go to, Crunchbase, Bowhurst is quite good. I don't know if you guys have a Bowhurst subscription that people can have access to. There are ways, there's a website, I found it recently, called Find a Shareholder, and you can work out how much equity somebody has. So you could look, all right, Sodom One Capital, great. They've made this nice announcement that they've just invested 200 grand into I don't know, AME, you know, and okay, and I can figure out and find a shareholder, they've got 20%. Right, great, 200K, 20%, they had an 800K pre-money valuation, 1 million post. So that is probably the best way to try and establish some type of value. But you've got to just pay attention to trends as well, because valuations change. So really understanding this, because if you go out and raise money and say, look, I'm willing to give away 10, 20, 15% equity, whatever it's going to be, you are going to get asked the question, how do you justify that? And the answer of, I don't want to give you any more than that, is not going to cut it, right? So you have to have some rational thinking behind why the business is worth what it's worth. And the best way that I know how to do that is understand the trends. This here, $500,000 pre-money valuation coming up to about $1 million right now. I think it's going to flatten out for a bit because valuations at later stages are kind of plummeting right now because they went pretty mad over the last 2 years. This flattens out. This will flatten out. So saying $1 million pre-money valuation is probably not unfair, but I would definitely go and look at businesses in your sector or someone that's more relevant, because there might be a different picture. You know, this is median pre-money valuations, but that might not, yours might be higher. And then you can add a premium for certain things like traction, wait lists. By the way, wait lists, the hidden gem that you should absolutely try and do. If you're building a product, you should absolutely try and build a wait list, or pre-sign-ups or pre-registered users, whatever it's going to be. The hidden gem, because it's traction without having traction, right? You can sell them on something you've not built, and then you can get their emails. Great. I looked at one that was an invoice financing platform, and he had 7,000 people pre-registered to use the platform. And I saw it thinking, crikey, I've not seen any other business that's had 7,000. I can work it out saying, look, even if that's like a whole load of rubbish emails and you've got 1,000, that's still a lot of people. If that drops through to 50 customers, as your very earliest customers, that's great. Subtraction changes the valuation. Deep tech, if it's, funny enough, if it's IP rich, if you've got something that is genuinely quite unique and it's taken a lot of time and resource to develop, then that will change valuations. Who knows the platform Hopin? Yeah, okay. It's an online events platform. It's like Zoom, but just slightly better. Maybe not, but it is different though. It is for events. You can go see a live stage and all of that. You can live stream straight into the platform. Funny enough, we invested in a business called Pixel Max. I don't know if any of you heard of it in Manchester. Oh, that breaks my heart. All right, great.
There are our neighbors at Bonded.
Okay, yeah. Pixel Max, great business. We invested 250. We then helped them about 6 months later raise about 2 million. On a nice little journey. They are doing 3D events. And when we invested, Hopin wasn't known at all. But why it's such an interesting space is because it's one of these emerging markets. It's one of these times where something is happening now that there isn't a market for it. You know, hybrid working, virtual, online events, hybrid events. It just wasn't a thing pre-COVID. And Hopin, you can see it, it's gone absolutely mad. It's probably valued about $8 billion now. It's only been going about 36 months. And I think the last time I checked, it's valued at something like 50 times ARR, or annual recurring revenue, which, if you know much about it, is just very high. It's very high, so that's going to come down. And then if you're a rocking founding team, or if there's previous exits or previous startup experience in your team, you see valuations go up. So it's not just a case of saying, right, well, Joe Bloggs raised this, I should also be valued at this. That's not the case. Anyway, that is it on valuations. Let me rattle through stuff. I'll go through this bit in the next 5 minutes, and then let's do some questions. We'll also save some time for whoever's next. No rush. But anyway, you're all going to come and speak to me another time when you're raising money, so we've got plenty of time. So forecasting, please don't do this. Don't do this. By the way, please don't share this with anyone, because this is actually a deck I got this week. Boom! Absolute rocket business. We'll be cash positive month one. £350 million valuation after 5 years. You will be richer than Elon Musk or Jeff Bezos if you invest now, and you'll get a 1 million X return. Like, by the way, no one does that, but you get my point. Like, this is not, I'm looking at this, and I'll tell you what I do. Done. I look at that and I think, your model, all you've done is you've made some nice little formula, you copied it and you've pasted it across, and all of a sudden, spits out this shed load of cash, shed load of profit. It'll be worth loads. You're not talking about who you need to hire, and you're going to do all of this from £250,000 when businesses that get to 350 million have probably raised 50 to 70 million in private equity. So disregard. There is a better way. I like to think. Now, I'm not going to give you a little template or something like that. This isn't going to be, I'll tell you, don't do that. I'm not going to give you a template, but there is a better way. So I just want to talk you through some of the principles. When you're forecasting or trying to work out, what am I actually going to go and do? It's not about trying to, and especially at the early stage. The early stage is not about, great, if I can sell to this many customers in this market at this value, blah, blah, blah. None of it is proven. What you're about to say is none of it at all is proven. So what's the point in extrapolating it if it's all 100% assumption and there's no evidence that you can actually execute? So good forecasting is a financial embodiment of what you are actually going to do. And I'm not talking about revenue right now. You are going to go and do a sequence of activities, and all of that's going to have a cost, right? So financial forecasting is what are you actually going to do. That's all got a cost. Let it drop out. That's how much you need to raise. And we'll talk a bit more about that in a second. But please, this here, and in the whole deck, by the way, I had no real feeling of what this person needed to now go and do in order to execute this next stage of their business. I had no idea about what it is. That's nice, but to be honest, it's given me no confidence. And my job especially is I've got to make sure that you don't take money and we run out 6 months later because of what you're actually planning on doing. So I look at that and I think, crikey, that's not telling me anything. I'm now going to have to do some hard work to figure out how much money do you really need and what are you actually going to do with it. Please save me some work in the future and don't do that and do this. Focus on, and this is such an important bit, focus on what do you need to go and do to demonstrate an increased value in what you're building. Okay, let's take the plan business. What's the name of it and what's your name?
I'm Claudia. I've just pivoted actually.
Claudia.
Yeah.
Yeah. Okay. let's take the plan business. All right. There's probably a handful of things that you need to prove at the earliest stage. One, what's the actual true market size? Where are customers and how do we acquire them? Quite an important bit. Supply issues, I don't know the supply model, but can we start to grow that? Can I start to get customers? Is there validation for what I'm doing? There are like a host of things that you're saying, look, if I need 200 grand, 100, 200 grand, I'm not going to build this 350 million pound business, most likely off a 200k investment. What I can do is the next thing, which is I need to start preparing I need to start proving a handful of assumptions that on my way to building a bigger business. I might need to raise money again, but you want to be in a position where you can say, I set out to prove something, I spent a lot of time doing it, and then we've actually proven and we've learned certain things. And that's, so if I was to, and by the way, I do this all the time with founders, ones that come to us and they're not quite up to scratch the deck. I'll spend time with them pre-investment shaping this and turning it into focusing on what you're actually going to, what you want to deliver, what do you need to go improve. So important to just laser focus on it. And it's based on as many knowns as possible. And then all of that, so what am I actually going to do? Who am I really going to hire? What am I specifically going to need to go and do? Yeah, we can add a bit of revenue into that, and then that's just going to drop out. If I do that, I need a certain amount of cash in order to fund this, right? So I might need 200 grand to prove X, Y, and Z, hire a couple of people. I want to try and prove that I can get revenue, right? It doesn't have to be a lot, but I need to prove that customers will pay for it and that there's a profitable model per customer. I can make a profit on each customer. I don't know what they're going to be, but laser focusing on the handful of important things that if you can prove those, the next investor will then say, crikey, you've got some really good proof behind you. You don't have a lot of traction yet because a very early stage or a very early fundraise won't give you too much. It could do, but the next investor will see what you've proven as the basis for their investment decision. And by the way, that happens the whole time. Like, that doesn't stop. What are you now going to go improve? It just happens to change that right now I don't know stuff and I need to go improve it. The next stage is I know a bit more. I now need to prove that I can increase or do a bit more of it. And then the next stage is, can I get from my 10,000 customers a month buying from me, can I get that to 10 million, right? And that's the journey that businesses go through. So focus on instead of these big decks, fancy things, I would rather you come to me with no financial slides showing that you'll be a £350 million business in about 6 weeks. I'd have no issue if you had no finance bits other than I want to raise a certain amount. Because if I can get a feeling from you that the market you've got, that you are really clear, that you've got deep insights into the issue you're trying to resolve, and then a very clear and rational thought of how to solve that issue. If you've got very clear understanding of how many customers there are like the ones that you want to go and buy from, and that's defensible. Like I had one this week where they had they were like, the market size it was a property tech business, so they were like, great, the market size is 30 million for renters in the UK, and the market size for this is 16 million. So I've got 16 million in my target market. And I said to him, right, well, let's talk through it a bit. And it worked out that his target market was actually the tiniest subset of both of those. He probably had 10 or 20,000 people in his target market, but he saw these big numbers, didn't understand them. And so for me, there wasn't a defensible understanding of how many people can you actually go and acquire, or are there to try and acquire. And then I don't want you to show me that you're gonna have this massive business. I just want confidence that there are plenty of customers like the ones you want to get that you'll be able to figure out at some point how to get them. You don't need to have the beginning and the end, and you don't need to figure out how you're going to do it and what revenue that looks like. For me, I'm interested, how much money do you need to prove some things? And I just need to have confidence that the market will be able to sustain your product once you are at a scaling point. I'll skip this just for time, but there's not a lot there, to be honest. I'm not covered. But real focus on what you're going to build. Too many times I see, great, like a little pie chart saying I'm going to spend 50% on development resource. That's fine. What are you going to build? And it's not just, I want to build the product. There are phases. Right now, selling equity at the earliest stage, taking on an investor is the most expensive time to take on an investor. So you don't want to raise too much, and investors won't put too much in until you've got proof. So it's about building something with the money you've got that proves an increased value in what you're building, getting the next investor on who will take a bit less equity, but clarity on what you're building and what you're setting out to prove is so important. And I'm not going to tell anyone, but from what I've seen, startups that do the best are the ones that focus, like the MVP, right? The whole point of MVP is about absolutely laser focusing on being exceptional with core features and then okay with the others, or bringing other services in, which you might then build out later, but exceptional at what one thing is and then building it out. And that's exactly what the fundraise is about, being able to communicate. We need to do this because they are the exceptional features that are going to help us to prove something else. And then I might have mentioned this a couple of times. What do you need to prove, right? This is just laser focused. I would rather, if you came to me to invest to ask for funding, instead of some fancy forecasting slides or anything, if you were able to tell me loads about the market, loads about the problem, loads about what you're going to build and how you validate that what you're building is right. And then if you came to me and just said, I'm raising money to go improve X, Y, and Z, I would love it. So please, when you come to me, because you all will at some point, when you come to us, please communicate that. And it's so much easier. Just sit on the other side of the table for a second. I'm an investor, great. Instead of going, you're going to have a £350 million business in about 6 weeks. If you say, look, I'm raising funds now on a realistic valuation because I've looked at the market, I've seen what other comparables there are, I've seen what other investors are investing at this stage. I'm going to add a bit of a premium because I don't really want to give us way too much. So I'm going to add a bit more and see if you knock me down. this is the market, this is the problem, this is what I need to go and build, this is why I think this is valid, and this is how I want to prove, or the things that I need to prove to start demonstrating that what I've got has got legs. And then we'll be able to raise money. So framing a pitch, framing an investment that way is so much more effective. Now, all of that, by the way, so my approach to forecasting, all of that as a cost, add in a bit of sensible revenue if that's what the plan is, and then out comes your financial model, right? I know that, so I haven't got a nice template for you, but principally, this is so much more important to understand now, because look, you're students or in education, whatever, you'll know your way around a spreadsheet. It'll be easy, that's the easy bit. The easy bit's the spreadsheet. The hard bit is the thought behind the cost of what you now need to go and build and prove. It's not about being a massive business now. And by the way, I'm not saying curb your ambition. Absolutely, I'm not saying that. You know, that has to be present. But what's the realistic approach to how you now need to go and build something to then prove a bit more value in what you're building, to then raise more money? That's it. That is it for me. So, we'll go to questions. I think we got 7 minutes. Oh, thank you. But yeah. Questions, if you got any. If not, I'll go home.
Is your company focused on certain sectors or across?
Yeah, so we don't touch things like life sciences usually. Depends what it is. We have looked at some life sciences ones, but that's not. We have a more of an e-commerce, retail, tech background. Not saying that's exclusively what we do. I was telling Nico that we've got a chain of physiotherapy clinics that we're doing a bit of a buy and build. So we're going to buy loads and then sell it to private equity. So we don't have any rhyme or reason, but things like heavy engineering, deep tech, and most likely life sciences are ones that we don't get too involved in. But to be honest, we will speak to anyone. And actually, like our commitment, if you ever did come speak to us, our commitment is that you would leave with some type of valuable feedback, even if it's not for us, in terms of how you would shape it. I was literally on one today where on the call, we knew it wasn't one for us. The founder's about to run out of cash. And we just said, look, we can tell you're about to run out of cash. You need to not come across as desperate. You need to focus in on what are you going to prove with the money you're about to raise. And by the way, what have you learned so far? What are the learnings that you've had to date? And what's the next thing that you need to build on top of that? Bit of a long answer, but...
No, that's what I've got on. So
Yeah.
low calorie alcoholic beverages, and
Okay.
one thing around is that laser focus.
Yeah.
To find that you can really change the picture and solve the problem. So that's really useful.
Good.
Little do you guys know that we'll be probably pitching these guys in about a month.
In 2
Yeah.
seconds.
I don't think we do alcohol, I'm afraid. So, yeah, alcohol and gambling is not ones we do either, and tobacco. So, yeah.
Mycology education from the life sciences.
I don't know.
No, me neither. That's up to the pitch.
Yeah, absolutely, absolutely. But by the way, you don't have to have a deck. If any of you wanted to come and speak to anyone about fundraising and how do I start to position it, getting ready to go, just speak to us. You know, pick up with Oliver or Nico, and yeah, any time you can have a session with us.
Just because I'm thinking about CICs. What about CICs? Would you ever invest in like a CIC company or
CIC.
community investor company?
Okay.
That's what I'm saying. Yeah, you would. Yeah.
I don't know.
Yeah.
I don't know, but let's see.
Yeah, cool.
So, no, we'll go with Claudia, right?
Yeah. So I'm planning on donating like a third of profits to charity. Would that put investors off?
No, what I would reckon it would do is it set up as like a social enterprise or? Okay, so I would probably. I think the thing you'll hear from a lot of them is, why don't you prove you can make a profitable business first, and then look at becoming having a social cause behind you. So get the model right, and then allowing that to kind of gradually come in. So that's what I think you'd hear from most people. I don't think it'd put investors off, but it's just about understanding. But also, most investors are investing understanding there's not going to be profit for a bit of time. So it probably gives you time to actually to prove the model, because businesses cost money. So, yeah.
One-page business plans required, is that right?
For me, in like a real ideal world, you'd send me a copy of your deck, which would be relatively easy to read, no longer than 20 slides, very simple, what you're going to prove, what have you got, founding team, and then I would maybe a bit of a financial model. That's all I'd send through. I don't really look at one-page business plans. I'd rather just get the phone call. So, yeah.
Do complex multi-step business models put investors off? So my startup is a life science, biotech, deep tech.
Yeah. Not for us, probably.
But currently we're building an MVP that I got that wrong, didn't I? I got the
MVP?
wrong. I think. Anyways, point is, we're currently building a model.
Yeah.
And that's a step towards our ultimate final device that is actually quite different, much deeper tech than what we're currently developing.
Yeah.
So it's like a 30-minute explanation of how the whole thing is going to work and why we're making it this way. Does this put off investors?
No, you'll find life science and deep tech will have a specific type of investor. Want to look at deep bridge capital, have a pre-seed fund for life science / deep tech. So like an investor like a deep bridge will be more fitting. Most investors probably won't come. Most investors won't do deep tech. That's the reality, because it's just quite a long period of time before commercialization. But there are relevant investors for that. So that's not just about like a scattergun approach across the market. It's about picking specific investors quite relevant.
Okay, can I guess follow up on that?
Yeah.
So our first product is intentionally made to be something we can get to market relatively soon. Does that broaden the range of investors?
I'll make a sort of an analogy.
Please.
Similarly, how Amazon started e-commerce, but the majority of revenues is made from AWS. They know their AWS, but are just using kind of the e-commerce just to keep them alive in the meantime. So
you do have a product. You're kind of building something underneath that. To be honest, it probably makes it easier. Maybe afterwards I'll ask you what they both are, because that'll be interesting to hear. But if it's definitely a deep tech focused business, then there is a specific type of investor for that, and there's specific type of investors for life sciences. So it might be that you can get somebody in understanding that there's a product you can commercialize now, but then there's also this deeper R&D that you're on with for your other aspects of the business. So, okay, yeah, please.
Is there like a minimum or maximum amount of equity you look to get?
We're quite different because we have people, like a team, that actually get quite involved. We're quite an active investor, so we're not, here's a bit of money and we're just going to disappear. Just keep an update every quarter. So we typically will take a bit more, but that's reflective of the effort we'll put in and hopefully reflective of the success, or being able to help have a bit more of a successful seed round when the time comes. So for us, our model is kind of like 15 to 20, 25%. Like I said, that could be up to $500,000. At the earlier stages, it's usually a bit less. But then after that, we just pretty much dilute it, meaning that when you give more equity to future investors, we're happy to go from 20% to 16% as well.
Do you invest in hospitality businesses?
Our typical model, I told you about Physio. Physio is an outlier, right? Ours mainly are businesses that are relatively easy to scale, which a hospitality business might struggle to fit that bill.
More tech, less bricks and mortar.
Yeah, we've done bricks and mortar, and I think we are going to try and not do it again. So, yeah. Is that good? Are we done? All right.
Thank you so much.
No, thank you.
Very much.
Thank you, guys.